Imagine going to sleep with a winning silver trade and waking up to find your account wiped out, not because you were wrong, but because someone changed the rules in the middle of the night. In just a few hours, silver collapsed from around $88 to $74, and more than 41,000 traders were forced out of their positions, liquidated one after another, like dominoes pushed by an invisible hand. The official story says risk management and normal volatility. But the timing of the COMEX margin hike, the strange order flow, and the way a few big players were perfectly positioned, all of it raises one simple question. Was this a crash or a setup? If you trade silver, gold, futures, or any leveraged market, what you're about to see is not just a story. It's a warning. And it could be the difference between keeping your account and losing everything overnight. Stay with me to the very end, because I'll break down exactly how this happened, who likely knew in advance, and how you can spot the same danger signals before they hit your screen. If you want more deep, honest breakdowns like this, hit subscribe, turn on the bell, and tap like to support this channel, so this kind of information keeps reaching the people who need it most. Now, let's follow the money and uncover what really happened behind the silver crash that liquidated 41,000 traders in one night. The crash did not start with panic on news feeds. It started quietly, in the thin hours of Asian trading, when silver was still trading near $88 an ounce and volume was low. At first, price slipped only a few cents at a time, like a slow leak. Then a strange pattern appeared on the tape. Sell orders arrived in large blocks, but with almost no pause between them, as if fired by a single hand. By the time Europe opened, silver had already broken below $84. Depth on the order book was almost empty on the buy side, while sell volume kept growing. That mismatch is a classic warning signal. It showed up before the 2010 flash crash in stocks, when liquidity vanished just as orders surged. Here, the same behavior reappeared in the silver pit. Around the US pre-market, the real drop began. Price sliced through $80, then $78 in minutes. Many traders had stop-loss orders just under these round numbers, like dominoes lined up in neat rows. When the first stops triggered, they pushed price lower, which triggered the next row, and then the next. The key irregularity is timing. The heaviest selling hit just before the COMEX margin hike was officially published, not after. Someone traded as if they already knew that leverage was about to become much more expensive. Who was hitting the sell button into a market that thin at that exact window of time? And how did they stay on the right side of a move that wiped out tens of billions in a single night? COMEX did not ban trading. It did something quieter but far more powerful. It raised the margin. Margin is the cash a trader must keep as a safety deposit to hold a futures contract. With leverage, a trader might control $1 million worth of silver with only $100,000 on the account. When COMEX hikes margin, that safety deposit jumps. Overnight, many traders suddenly do not have enough cash to keep their positions. This change turned normal trades into emergencies. Long traders, already hit by falling prices, saw new margin calls appear on their screens. They had two choices: wire in fresh money fast, or sell contracts to close their positions. For thousands, there was no spare cash. Selling was automatic. The size and timing of this hike stand out. COMEX raised both initial and maintenance margins by a large double-digit percentage, and it did so right into a falling market. In 1980, when the Hunt brothers tried to corner silver, exchanges also used steep margin hikes to break their leverage and crash the price. In 2011, a rapid series of silver margin increases came just as price tried to push above $50. The pattern is clear. When margin rises sharply during a rally, it cools speculation. When it rises during a crash, it throws fuel on the fire. So why now? Was the hike a neutral response to higher risk, or did someone pressure the exchange, knowing that highly leveraged longs would be forced to dump at any price? Just as in the previous slide in price, the question of who understood this rule change in advance hangs over the entire event. When the dust settled, the records showed more than 41,000 trading accounts liquidated or forced to close. On a screen, that is just a number. In real life, it means tens of thousands of people and funds pushed out at almost any price the system could grab. The pattern of these losses gives clues about who they were. Small retail accounts tended to vanish first, especially those using phone apps with high leverage option. Then came mid-sized speculative funds, which often ran the same playbook: long silver futures, short the dollar, and using borrowed money. Finally, some algorithmic desks were caught when their models kept buying the dip, not seeing that liquidity underneath had already disappeared. The irregular signal is how tightly grouped the damage was. Account blowups clustered in the same 60 counted in a 90-minute window across different brokers and regions. That is not typical. In a normal sell-off, traders fail at different times. Here, they fell together, like houses built on the same weak foundation during an earthquake. We have seen this kind of crowd failure before. In 1998, long-term capital management used similar models and leverage assumptions as many banks. When markets moved outside their forecasts, losses hit everyone at once and forced a rescue. In 2021, Archegos collapsed after several prime brokers let it stack the same bets over and over. So who allowed 41,000 players to lean against the same door using the same fragile mix of leverage and faith in normal volatility? And why did risk teams, at brokers and funds, miss the growing stress signals that now look obvious on every chart? Money never really disappears in a crash. It moves. When 41,000 traders were forced to sell, someone else was on the other side, ready to buy or to close, winning short positions. That side of the tape is where the real story begins. Clearing data and futures reports show a sharp rise in profitable short positions, held by a small group of large traders, mainly bullion banks and global macro funds. They had been building these shorts quietly in the weeks before the fall, even as public commentary stayed bullish on silver. It was like watching fire insurance purchases surge in one neighborhood right before the first house catches flame. One irregularity stands out. In the 2 sessions before the margin hike, put option volume on silver spiked at strikes just below $80 and $75. Many of those contracts moved deep into profit within hours. This pattern has appeared before. Ahead of the 1987 stock crash, a few desks loaded up on out-of-the-money index puts, then cashed in when portfolio insurance selling kicked in. Block trade records hint that some players did not just win, they timed both sides. They went short futures into the slide, then flipped and bought contracts back near the lows, capturing the full swing. That strategy needs confidence that forced selling will appear on schedule, like knowing exactly when a dam will break. Who was confident enough to place those trades in that size just before the rules changed? And were they simply skilled at reading risk, or did they sit closer to the pipeline of information that most of the 41,000 never saw? To understand this crash, you have to look backward. Silver has been hit like this before, and the fingerprints are strangely similar. In January 1980, during the Hunt brothers saga, exchanges suddenly changed the rules. They raised margins again and finally allowed only liquidation orders. Prices collapsed, not just because buyers vanished, but because the rule book moved while trades were already in play. Again, in 2011, when silver rushed toward $50, COMEX pushed through a rapid series of margin hikes. Media stories quickly shifted tone, from talking about a new era for silver to warning about a bubble and reckless speculators. Within days, price reversed and plunged. The pattern was clear even then. When silver starts to behave like a threat to the existing financial order, the tools of risk control come out. The present crash follows the same path. A big rally, growing public interest, tight physical supplies, then an aggressive margin change and a flood of stories describing the fall as a healthy purge. The irregular piece is timing. In all 3 cases, 1980, 2011, and now, the strongest rule shifts arrived only after silver had already challenged old price levels, as if stability only mattered once certain lines had been crossed. It is like a game where the referee lets play run freely, right until the underdog team takes the lead, and then suddenly whistles every small contact. Officially, it is still the same sport. In practice, the flow changes, so is this just cautious risk management each time, or a repeating method of keeping silver in a controlled range when it becomes too loud a signal about currency and trust? When the futures price of silver hit $74, the shock did not stay inside trading screens. It pushed straight into the real economy that lives off silver. Miners, refiners, ETF issuers, and coin dealers. Mining stocks were the first public casualty. Many large producers fell 20 to 30% in a single session, a move that priced their future earnings as if silver had dropped not to $74 but to something closer to $60. That disconnect is a warning sign. In 2008, during another metals slump, miners briefly traded as if the underlying commodity would stay depressed for years, just before prices turned. Then an odd split appeared. While COMEX prices were falling, physical premiums at dealers stopped falling with them. In some cases, they rose. Retail buyers trying to purchase coins in small bars saw higher markups and longer delivery times. It looked like a store advertising a clearance sale while quietly locking half the doors. Refiners added another layer of tension. Some began quoting longer lead times, or even no offer for certain product sizes, despite the headline crash in futures pricing. A similar fracture showed up in 2008 and again in March 2020 when paper metals prices dived, but physical metal became hard to secure at those levels. ETFs tracking silver also flashed red. Intraday, a few traded at discounts to their net asset value, hinting that authorized participants were slow or unwilling to arbitrage the gap. If the futures price is the true signal, why does real-world silver behave as if the metal is scarce, not plentiful? And how long can a market function when its main price gauge starts to look less like a thermometer and more like a suggestion? By now, the outline of this event is clear. A sharp margin change in a thin market, a wall of forced selling, tens of thousands of liquidations, and a small circle of players ready to profit on both the way down and the rebound. The tape does not read like a natural storm, it reads like a stress test that broke the machine. The deeper signal is about structure, not just price. Silver trading today leans heavily on leverage, models, and trust in a few central venues like COMEX. When one rule change can flip the market from euphoria to ruin overnight, it shows how narrow the real support under the price has become. It is like a tall tower built on a very small base, impressive from a distance, fragile up close. History adds weight to that concern. In 1980 and 2011, rule shifts and margin tools were used to cool silver just as it began to send a loud message about inflation and currency stress. Now, the same pattern resurfaces at higher prices, with more debt in the system, and with more people treating futures prices as the truth for everything from mine planning to ETF design. The open questions are the most unsettling. Who shapes these margin decisions and with what inputs? How much unseen pressure was there from banks, regulators, or even large industrial users? And if this playbook worked smoothly on silver, what stops it being used again on other crowded trades, from gold to tech stocks? This crash looks less like a closed chapter and more like an early warning about how quickly modern markets can be steered and how little room there is when everyone leans on the same exit. The trail left by this silver crash points to a larger story than a single bad night of trading. We saw an overnight price fall from 88 to $74, triggered and amplified by a sudden margin hike. We saw 41,000 traders pushed out in a tight time window, their positions treated as raw fuel for a move that rewarded a small group of prepared players. We saw echoes of 1980 and 2011, where similar tools were used when silver's message about money and risk grew too loud. Taken together, these pieces describe a market where control sits in a few hands. Exchanges can change the cost of leverage in hours. Banks and funds with better data can adjust before the crowd. Media can frame the event as a healthy correction, even when the pattern looks more like a managed reset than a natural cycle. It is not proof of a single plot, but it is evidence of a system that regularly protects itself first. The most important signal may be the growing split between paper and physical silver. When futures prices crash while real metal stays tight and costly, trust slowly moves away from screens and toward whatever people can hold or directly verify. That shift has appeared in other crises, from 2008 credit markets to 2020 supply chains. What comes next depends on whether this event is treated as a warning or forgotten as noise. If leverage stays high, if a few venues keep setting the reference price, and if similar patterns reappear in other assets, then this silver crash will look, in hindsight, like the first clear crack before a wider break.